So we're starting with the new topic now. AS26 intangible asset apply to all the three levels of enterprises. Right? A similar topic, almost equal to AS10. All the concepts will be same. Few concepts you're going to learn new, which were obviously not there in AS10 because this is intangible asset and those were tangible assets. So only some different points you're going to learn, not all. Now, what you are going to exactly learn in this topic, sir, in simple terms, I'll say, you're going to learn the detailed accounting treatment with respect to intangible assets in this particular accounting standard. Means first, you will learn the definition of intangible asset, means how to identify that yes, it's a intangible asset. So you have to learn the definition. Followed by recognition criteria, means whether this intangible asset should be recorded in the books or not. And sir, trust me, the recognition criteria that you learned for AS10 is exactly same for AS26 also. Same recognition. Then we will be learning the measurement of the cost of the intangible asset. Means at what value the intangible asset should be recognized in the books of accounts. Then on 31st March, what should be its carrying value? Means we will be learning the concept of amortization. Trust me, on these intangible assets, we don't charge depreciations. We charge amortization, which is very much equivalent to a depreciation only. So we will also be learning the concept of amortization. Then again, impairments will come. Impairments we have already done in AS10. The same logic will be repeated here again. Then finally, derecognition. Derecognition means when should an intangible asset be eliminated from the balance sheet. Same what we learned for AS10 also. So this is all we are going to learn in this particular topic. So first I'll start with the objective of the standard, what it says. To prescribe the accounting treatment for intangible assets that are not dealt with specifically in another accounting standard. Means, sir, there are few AS which talk about certain intangible assets. So for those intangible assets, AS26 will not speak. So that will be removed from the scope. But for all other accounting standard, for all other intangible assets, AS26 will speak. AS26 requires an enterprise to recognize an intangible asset if and only if recognition criteria are met. AS26 also specifies how to measure the carrying amount of intangible asset and requires certain disclosures about intangible assets. So there is a huge disclosure requirement also for this. That is also what we have to see at the end of the topic. There are some 8 to 10 points. Now, sir, before going ahead and understanding the scope, we will first understand the definition of an intangible asset. Once we are cleared with the definition, then I will go further for the scope. So let us now try and understand what do you exactly mean by intangible assets. Now, sir, I think you have already learned something about intangible assets before, and this is what you learned, that, sir, any fixed asset which cannot be touched, seen or felt are called as intangible asset. And people give a direct example, sir, goodwill, brands, patents, copyright. You're absolutely correct. But in that definition, we would try to add up some more points, right? So that one point is very much common, that intangible assets will not have a physical substance. But apart from the physical substance also, there are one or two more points that has to be considered while saying that it is an intangible asset or not. So let us now have a look at the definition of intangible asset. And trust me, sir, if you are coming across any asset, first, if you feel that yes, it's an intangible asset, you should first put it in the definition. If it fulfills the definition, then only it can be considered as an intangible asset. Right? And after that, you can check the recognition criteria to see whether it should be recorded in the books of accounts or not. Correct? So let us see now. What is the definition of intangible asset? An intangible asset is an identifiable non-monetary asset without physical substance, but it is held for use in the production or supply of goods or services, or for rental to others, or for administration purpose. So, sir, if I'm not wrong, the fourth point is exactly similar to that of the definition of property, plant, and equipment. But what are the 3 points? Identifiable, non-monetary asset without physical substance. Without physical substance, everybody knows. You cannot see, you cannot touch, you cannot feel. Right? What is non-monetary asset? Sir, non-monetary exactly same as AS11. Means the values will change. The money values cannot be fixed. The values keep on changing. That is called as it's a non-monetary asset. And point number one, an identifiable asset. Identifiable means it can be having a separate identification. Means it can be identified separately as compared to other assets. Means you can sell it separately. You can rent it separately. You can use it separately to earn revenue for your business. So identifiable clause, non-monetary asset without physical existence. These three are the major conditions to say whether it is an intangible asset or not. Plus, the important point, it should be used in the ordinary course of business, either for manufacturing purpose or for trading in goods or services or for giving it on rental to other. Means you have some patent, you can give it to others on royalty basis. You have a copyright of the book, you can give your copyright to the publisher to publish the books and give you royalty out of it. That is called as to rental to others. Or for administration purpose, sir, the softwares that you use in your business for your general administration purpose, sir, why to go anywhere? Best example is JKSC software only. If I'm not wrong, you people have not filled any hard copy of the admission form. All your entire admission process was done online only. And all your fee receipts are also generated online. It's an online system. So JK Shah has invested lakhs of rupees for such type of software. And that software is an intangible asset for them. And that software is used in the business for administration purpose. Now, even I have softwares which I use in my business. Income tax return software. I have a tally software. Right? These softwares are what? Intangible assets for me. Why? Because it helps me to provide service to my clients. Yes or no? Now, best example, Zoom. Right? Now, Zoom also we have to take subscription, but the difference is what, Zoom subscription we take only for monthly basis. So that is why it cannot be getting capitalized. Now, Microsoft Office 365, you get 1 year subscription, single user 1 year subscription, 1,000 rupees. So that is only for 1 year. So it is directly charged to the P&L account. But when you take a lifetime edition, now, for example, with my laptop, I had taken Windows 7 because my laptop is 9 years old. So I had taken Windows 7 original subscription. In that year, it was for some 7 or 8,000 rupees. So that 7 or 8,000 technically was an intangible asset for me, and I capitalized in the books of accounts. Reason, it is lifetime subscription. I did not pay again and again. Right? And that is helping me for providing services to all my clients and my students. So that becomes what? An intangible asset. But sir, before going ahead, I would like to put one point over here, that this identifiable clause is not compulsory clause, because there are some intangible assets which you are actually using in the business, also earning revenues out of it, but they cannot be separately identified. They cannot be separately identified means they are actually combined with some other assets and used in the business to earn revenue for you. Can anybody tell me what are those intangible assets which cannot be separately identified, but still they are used in the business? Can anybody try out which type of assets they are? Niranjana has given me an answer, goodwill. Dikshit gives an answer, goodwill. Self-constructed goodwill. You people are absolutely correct. Sir, self-generated goodwill is that intangible asset which is not having a separate identification, because you cannot separately sell it, rent it. But sir, it is helping you in your business to earn a good amount of revenue. So technically, goodwill combined with other assets helps you to earn revenue for the business. Best example, JK Shah classes. JK Shah classes has such a huge goodwill. It is self-developed goodwill. And goodwill with the help of other assets in the business is helping JK Shah classes to earn good amount of revenue. Right? A good answer. So goodwill or self-generated brand values, right? These are what? Intangible assets without identifiability clause. They cannot be identified separately. Right? So let us read further about identifiability. The definition of an intangible asset requires that an intangible asset is identifiable. To be identifiable, it is necessary that intangible asset is clearly distinguished from goodwill. Means it should not be goodwill, it should be other than goodwill, like for patent or copyright or computer software or any technical know-how or startup cost or advertisement, heavy expenditure on advertisement, etc. Because goodwill and brand will not have separate identifiable clause. An intangible asset can be clearly distinguished from goodwill if the asset is separable. An asset is separable if the enterprise can rent it, sell it, exchange it, or distribute the specific future economic benefits attributable to the asset without also disposing of future economic benefits that flow from other assets used in the same revenue earning activity. Means the logic is the enterprise can calculate separately the future economic benefits that can be ascertained by the use of these separately identifiable assets as compared to the revenues that you are earning from other assets. So if it is separable, then you can also calculate the future economic benefits of that particular asset. But if it is not separable, then it is not identifiable. Then the point is you cannot ascertain the future economic benefit of it separately. Though separability, now please understand this, though separability is not a necessary condition for identifiability, if an asset generates future economic benefits only in combination with other assets, the asset is identifiable if the enterprise can identify the future economic benefit that will flow to the enterprise. Means even if they say the asset cannot be separated from other assets, but still you can calculate that what inflow that asset is able to generate, you can still identify. Means for example, goodwill cannot be separated from other intangible assets. But if as an enterprise you can work out how much extra you are able to earn because of goodwill, then goodwill can also be considered as a separately identifiable asset. But sir, no point in it because self-generated goodwill is not recorded in the books of accounts. The value is always zero. Right? So simple thumb rule with identifiability clause is that an intangible asset, if it is separable from other asset, we call it as it can be identified separately. And identifiable separately means you can either rent it separately, you can sell it separately, or you can exchange it separately, and you can also calculate the future economic benefit of it separately as compared to the other assets. But only two intangible assets, self-generated goodwill and self-generated brand values, are not fulfilling the identifiable clause. But still, they are intangible assets because they are earning future economic benefit for your enterprise. As simple as that. So for any asset to be an intangible asset, please put it in the definition of intangible asset and see to it, even if identifiable clause does not fulfill and other clause fulfill, it can still be considered as an intangible asset. I hope you get my point. Right? Let us go ahead. Now we'll go for the next part, that is the scope of AS2. Sorry, I'm really sorry. Scope of AS26. Yes, Srija.
Sir, can you hear me?
Yes.
Sir, in the definition, they have given like they have compared that in separation of intangible asset to goodwill, sir. So they're just comparing, or is it anything else? If you can just
I did not understand, madam. Can you please repeat? Sorry,
just
I did not
scroll
understand.
back to the definition, sir.
Okay, I've come to the definition. Okay.
Yeah, in the in the clause they have given that clearly distinguished from goodwill. So they're just comparing with goodwill, the intangible asset.
See, when you proceed further, you will come to know that when a intangible asset cannot be identified separately in the business, any intangible asset,
Yeah.
it is considered as goodwill only.
Okay, okay, okay.
You will come to know about it. Means, for example, you have generated a brand,
Uh,
right? So that brand is also treated as what? A goodwill only. Until and unless you cannot separately identify the
okay.
brand value,
So without any specific character, it goes into goodwill.
it is considered as goodwill of the business only.
Yeah, thank
And
you,
it
sir.
becomes a self-generated asset, so it is not recorded.
Yeah. Thank
Yes,
Sir, I
sir.
think that is also because when you see any company's balance sheet, goodwill is separately disclosed. Like it has a separate as an item. Intangible assets is different, and goodwill as one item is different. That I think is because of the goodwill as a loan item has a very substantial amount. So that's why they separate it from the other intangible assets.
But sir, in that case, the goodwill might be a purchased goodwill, because any company cannot show a self-generated goodwill in its balance sheet because it does not fulfill the recognition criteria. Even I will come to it when we reach to the how to calculate the cost of the intangible asset. So I'll be linking it with the recognition criteria, because it is not practically possible to ascertain or allocate a particular cost to your goodwill if it is self-generated. Means you cannot say that your goodwill is generated because you incurred this cost or because you incurred that cost. You cannot reliably measure the cost. That is the major reason. And since you cannot reliably measure the cost, goodwill does not meet the recognition criteria. So if at all you have seen
Yes, sir.
goodwill in any company's balance sheet, it is purely purchased goodwill. Means they might have purchased from
Okay.
some person their goodwill. Means, for instance, I want to open up a McDonald's outlet in our area where I'm currently staying. We don't have a McDonald's. So I'm planning to open up a McDonald's over here. But McDonald's people have to pay 3 crore rupees for the franchise. So 3 crores that I'm technically paying is nothing but goodwill to McDonald's. Because if I start my own current Donald's, nobody will come. But if I open up McDonald's, I will get business from day one. Yes or no? Because current Donald's nobody knows.
Yeah.
McDonald's everybody knows. So 3 crores, and it's a factor,
Yes,
sir. I
sir.
have to pay 3 crores, 3.5 crores to McD and have at least a 500 to 800 square feet of place. Then they give us the license. It's very expensive, but it is remunerative. We friends had once had a word with this McD people. We 6 to 7 friends. We thought of actually opening a McD outlet, but the investments was so high that 3.5 crores only for the franchise fees, and then further 1.5 crore for setting up the kitchen and everything. So overall, it was a 5 CR investment. So it was being divided between
Yes,
5
sir.
people. So every person had to give 1 crore.
Yeah, these recognized brands like that. So in Bangalore, we have something known as Corner House, which is an ice cream parlor, basically. Very expensive, sir. If you want to buy a franchisee, 1.5 crore for just an ice cream parlor.
Exactly. In Mumbai, we have there is one outlet, Cream Chills. So Cream Chills, those people take some 30 or 35 lakhs for giving their brand name, and they only supply all the ice creams and all. It was actually started with 1 or 2 outlets, but then they decided to go on with chain of outlets, and now they are a franchise. So they only give you all the manufactured ice creams and all, You just have to sell them over the counter, and they have got some mixture of ice creams also. So different dishes they make out of ice creams. So 150, 200 to 300 rupees one dish, the prices, but good business. So basically that is what is purchased goodwill. So when you purchase their franchise, so whatever fees you are paying to them, you can also call it as a franchise fees, or you can call it as goodwill to them also.
So basically, self-generated goodwill will never come in your balance
It
sheet.
will not meet the recognition
Because-
criteria.
Yeah, because how can you value your own goodwill?
Exactly. And if you are
That's
able
the
to
basically.
exactly. See, for the purpose of selling the goodwill, I can value my goodwill on the basis of profitability. But to record it in the books of accounts, on what basis should I allocate the cost to it? Because any asset should be recorded at its cost. So it is not technically feasible for me to allocate cost to the goodwill. I cannot say what cost exactly I have incurred for generating or developing my goodwill. I cannot say that.
Yes, sir.
That is why they say goodwill cannot be recorded unless and until it is purchased. Right?
Yes, I got it.
Let us go ahead now. Anshul Bafna, you were in the morning batch also. Na? You are attending 2 times by paying single fees. Where are you, Anshul Bafna? Morning also you were there, na? Or first sometimes you were there and after that you left. Single fees, double maja. Good. Half hour only you were there in the morning. Okay. Because I think in the morning batch some students had exams. So after a few particular time, they left the class. So I think some people might be joining now. Achha, he had fest, but some people had exams. Chalo, let us go ahead now. I hope Shrija, you are clear or still you want to speak something? Shrija.
No, sir. No, sir. Thank you. It's clear.
Okay. Please lower your hand. Now let us understand the scope of the standard. It's having a big scope. AS 26 should be applied by all enterprises in accounting for intangible assets. That is, it is applicable to all the 3 levels. We've already learned it, but it is not applicable on the following points. Right? Let us start. Intangible assets that are covered by another accounting standard. For example, AS 26 does not apply on intangible asset held by an enterprise for sale in the ordinary course of business. So technically, when intangible asset is sold in the ordinary course of business, it is either covered by AS2 inventory because it becomes your item of inventory then, and AS7, that is your construction contracts. So generally in construction contracts, what can be intangible is nothing but the architectural services that you are going to sell to different people. So that can be considered as your intangible asset for AS7, and for AS2 also. Yes, you can trade in intangibles. You can be a trader of some intangible assets. Definitely, yes. Why not? You can be. Then deferred tax asset AS22, it is covering by AS22. Then leases that fall within the scope of AS19. So generally the lease agreements are intangibles only. But since they are already covered in AS19, we have already seen how to account those leases. AS26 is silent. AS26 will not speak about it. Goodwill arising on amalgamation, which is covered by AS14. Even I will be talking about this goodwill today. In the later 15-20 minutes after that, we will be talking about this, as well as goodwill arising when consolidation of financial statements take place. Means when the holding and subsidiary financial statements are consolidated together, goodwills arise. So that is taken care by AS21. So I think consolidation of financial statement topic is there for you people at inter level also. So you will be learning it there as well. This AS completely, I don't know whether they are covering in that, but consolidated financial statements as a separate chapter is covered to you people. Right? Then, second point, AS26 is not applicable on financial assets. Financial asset means, example, cash is a financial asset. contractual obligation to receive cash or contractual obligation to pay cash is a financial asset because we have a relevant Ind AS for it. That is why it is not covered by AS 26. So AS 26 is completely silent. And actually for financial assets now, we also had an accounting standard earlier, AS 30. We had AS 30 earlier, but that AS 30 is no more now. Then mineral rights and expenditure on exploration for or development and extraction of minerals, oil, natural gas, and similar non-regenerative resources. So expenses incurred on these type of minerals or natural gas, or when you pay the mineral rights to the government. Now please understand, if there is coal at one place, you cannot directly go and extract coal from there. You have to pay license fees to the government to take the rights to extract the coal from that area. Say you pay 100 crores to government to extract coal from there. So 100 crores that you are paying is technically the amount paid for mineral rights or for extracting minerals from there. So technically that 100 crores that you are paying is the right that you are getting, and rights when you get is nothing but intangible only, but it is not covered by AS 26 because generally there is no accounting standard covering all these things. These are all depleting assets, and for depleting assets, even AS2 has lifted its hand. AS10 is also not speaking. AS26 is also silent. So they are accounted as per the standard market practice, record at the value at which you are purchasing it, and amortize over the term of such contracts. Means if you have got the contract for 10 years or 15 years, write off whatever you have paid over a period of 10 or 15 years through the profit and loss account. Then lastly, intangible asset arising in insurance enterprises from contracts with policy holders. This is specifically covered in Ind AS 104, which we will be learning at final level. But one point that everybody might be thinking, sir, what type of intangible asset generates for an insurance company when it is giving policy to the policy holders? Sir, the intangible asset is customer relations, and the intangible asset is the customer list that you are going to get. Now, I have my insurance policy with HDFC and I have my insurance policy with LIC. So if I'm happy with those people, will I suggest my friends and relatives also to buy the policies from HDFC or LIC? Yes or no? So technically for HDFC or LIC, the customer relation that they have maintained with me is an intangible asset. And how to value it, you learn it in Ind AS 104 at CA final level. Sir, but how it can be an intangible asset? Yes, it is, because it is helping them to generate business for future. Now today I have an insurance with HDFC. I'm very happy with HDFC. The services, the app support that they are giving, they don't harass me every time for paying the premium. They give me 1 or 2 reminders and then topic is over. Because some insurance company, they call you like anything. Sir, when are you paying the premium? When are you paying? It is my policy. I will pay or I will not pay. Who the hell are you? They call you as if you are having some outstanding due on your credit card bills. They call you like that. ICICI people and all these people call like anything. Sir, when are you paying? Sir, when are you paying? You're going to pay on 20th? Okay, sir, I'll give you a reminder on 20th also. On 20th, the full day they will call. Sir, did you pay? Even after paying this, people call you 3 or 4 times. Sir, did you pay or not? If you paid, please share us with the number for the transaction ID. What do you want to do? Once this LIC people never called, but I had once got harassed with LIC people to pay the premium. I just told him one thing, boss, it is my policy. If I don't pay, who is going to be at a loss? You or me? It is technically me. Then why are you calling me? I will take care of myself, don't worry. Never call me again. So these people harass. I am happy with HDFC, at least they don't do like that. So I will technically tell others also. Now, even I am telling you people, take insurance from HDFC. Right? So my customer relation with HDFC is an intangible asset for them, which is helping HDFC to bring business. So I'm telling to 130, 135 people in front of me, please take HDFC Insurance. Right? It's a good company. So let's go ahead. Then, however, AS26 applies to other intangible assets such as computer softwares and other expenditures such as startup cost. Startup cost means when you start a new business. When you start a new business, there are many startup costs. Licensing fees are there. You take GST license. You have to take shop establishment license, right? Then if you are opening some restaurant and all, you have to take FSSAI license. So all these expenses are considered as what? Startup cost. Basically, these are nothing but paperwork fees. Because for fixed assets and all, table, chair, window, air condition, that all are fixed assets. But whatever you pay for consultancy services, you paid, right? For you paid some lawyer fees for getting some licenses and all. So those all become what? A startup cost, and it can be capitalized as an intangible asset. Then in extractive industries or by insurance enterprises. Now, technically, startup cost can be coming in any type of industry. So startup cost is not specific to any particular industry as such. AS26 also applies to expenditure on advertising, training your employees or training your staff, and startup costs. Research and development expense, one of the most important points of this standard that we are going to learn separately, that how to account for research and development costs. Rights under licensing agreements for items such as motion picture films, video recordings, plays, manuscripts, etc. Means, for example, when say a production house sells their rights, satellite rights to these OTT platforms, Amazon Prime or Disney Hotstar or Z5. So technically, they are charging a huge amount from these OTT platforms. So for these OTT platforms, it becomes an intangible asset, which they recorded in their balance sheet because they have taken the rights to show exclusively these movies on their platform or the web series, whatever it is. Then patents, goodwill, copyright, trademark. Now, whenever the goodwill word comes, it is always purchased goodwill, because self-generated goodwill is not to be shown in the balance sheet. Right? So till here, we have covered 3 points: objective, definition, scope. Anybody with any sort of queries with these 3 points can please raise your hand immediately and clear it off. Yes, Harshit. Harshit, you're not audible. Yes, Vishal.
Good evening, sir. The
Good
point
evening.
about customer relations in insurance enterprises, is it applicable
Yes.
only to insurance companies or to any other similar companies, sir? Maybe
It is
banks.
applicable to similar companies also, because the end of the day, customer relations is always an intangible for any of the enterprise. But generally, specific Ind AS is made for insurance contracts, Ind AS 104.
Okay.
But for anybody or customer relation, now for classes line also, customer relation is the key intangible asset. Because if you people are getting a good service at JK Shah classes, you are going to definitely tell your juniors about to join JKSC. Yes or no? But if you are not getting a good service, then you will not tell. So we always try to provide you the best service possible, so that you people pass on your good experience with your juniors. So juniors also come in and join with us. Yes, Sakit.
Sir, I didn't understand this point of research and development activities.
Sir, we have not started only. I said it will be covered in detail. So you have to wait for 45 minutes.
Okay, sir. Okay.
Sir, I'm
Yes,
audible?
Mohit. Harshit, please speak.
Sir, I didn't understand the point regarding startup cost, sir. Can you once
Sir,
explain?
startup cost is when you start with a new business,
Yes, sir.
right? There are many costs that you are incurring, which benefit is going to get for a period greater than 1 year. Means I gave you certain examples of you when you start some business, you have to acquire some license. So for acquiring the license, you pay the license, you will pay the license fees. Plus, you may also require a lawyer for consultancy or for getting all these licenses. So you will be paying some consultancy fees to the lawyer, and you may pay some legal charges to the lawyer. All these
Yes.
things will be considered as a startup cost. And some organizations require a huge startup cost, some
Yes,
lakhs
sir.
or crores of rupees in the form of startup cost. And technically,
Okay,
the
sir.
benefit is available for greater than 1 year. Hence, it is capitalized as an intangible asset.
Yes, sir. Okay. That how can it? I was confused with how can it be considered as intangible asset. So,
No, only one reason is what you know. The benefit of this cost is greater than 1 year.
yes, sir.
Means when I'm taking a license to do a business, I'm not using exactly the word preliminary expenses. With only reason is AS 26 earlier used to exclude preliminary expenses from the scope. Now it is not specifically written in module, but yes, preliminary expenses are very much close to your startup cost. I would say almost equivalent, no change.
Okay, sir. Got it.
Yes,
Thank you.
Mohit. Yeah, welcome.
Sir, in general, how many? 41 or more?
Sir, you are not audible.
Normally. How many India?
Your network is very poor, Mohit.
Sir, am I audible now?
Yeah, please speak.
Hello.
Yes, please speak.
Sir, how many Indias are there? How many
Sir, you have
Indias
almost
in general? 41 or more
40,
Indias?
40 Indians. 35 are active, 40 are there, total 35 are
The
active.
number in
And I think
India
that final level, you are going to learn 30 Indians in final. Total 30 Indians you are going to learn in final.
so numbering is given by some other means Indias 104.
Some Indians will have a similar number to accounting standard. Like for example, AS 24 is discontinuing operation, and Ind AS 24 is also discontinuing operation. So some AS and some Ind AS numbers are same. Like Ind AS 2 is valuation of inventory only, and AS 2 is also valuation of inventory.
Yes,
Yes, Shweta.
okay.
Sir, self-generated goodwill is not at all recorded in the books of accounts.
No.
And all,
No.
Yes, sir. And AS 26 does not apply to the goodwill which are acquired by consolidation and amalgamation. Then what does this goodwill refer to, sir? I mean, the fifth point of AS 26
Purchased
applies.
goodwill. Purchased goodwill. We gave the example of McDonald's, and one Ritik gave example of Bangalore, some ice cream outlet. I gave one ice cream outlet example of Mumbai. So when you purchase their brand to run your business, that is called as purchased goodwill.
So that will be reported. Okay, sir. Thank you, sir. Thank you so much.
Yeah. Yes.
Sir, sale of self-generated goodwill.
1 minute. Please read the statements properly. And first, switch off your camera. Your net connection is poor, sir. Switch off camera and then speak.
Sir, is sale of self-generated goodwill be included in AS 26?
No, sir.
In any of the AS, sir? In any other AS, it is included?
Sir, I have not seen anything like that. No.
So then how will McDonald's account for that 3 crore?
Sir, that is their franchise fees, income for them.
Okay, sir. Okay.
So even any brand, if they are selling their franchise, it's an income for them. Franchise fees, revenue, sir. And if the revenue is for say for you have given franchise for 5 years, and they have given you fees 5 crores. So technically 5 crores is amortized in 5 years. The revenue gets accrued over a period of 5 years. Correct? Is paying royalty and goodwill very much similar? Like when I talk to around about your franchise or license fees, it is similar to royalty only. Similar, but if for the person who is selling it, for them it is an income. So they can account it as royalty also. Yes, it is possible. Correct. Let's go ahead. Okay. Now let us move ahead with the next part. Sir, recognition criteria of intangible asset. Now it is exactly cut, copy, paste from AS10. No change at all. An intangible asset can be recognized in the books of accounts first if it fulfills the definition of intangible asset, and secondly it should fulfill the 2 recognition criteria. So what are those criteria? Same. Point number 1, the future economic benefits associated with the intangible asset will flow to the enterprise, and the cost of the asset can be measured reliably. So technically, I would say for recognizing any intangible asset, total 3 points to be fulfilled. First, fulfill the definition, and then 2 recognition criteria. And what are the 2 criteria? Are same. Future economic benefit should flow to the enterprise, and second, cost can be measured reliably. And I think this is what you have already learned at your AS10 level. Correct? Only an revision over here is taking place. Now we start with the next part of the topic. Measurement of initial cost, a lengthy topic now from here. And sir, before starting, 2 points I would like to cover here itself. Point number F and point number G. Point number F, that is how to measure the cost of internally generated goodwill. It is always 0. Internally generated goodwill's cost is always 0, with the only reason that cost cannot be measured reliably. We cannot allocate a specific cost. We cannot allocate a specific cost to our goodwill. Now, for example, if JK Shah classes says that we have goodwill, correct? So yes, they are having, I don't deny with the fact, but sir, they cannot actually calculate the cost of that goodwill. Means, sir, how will sir calculate? What will he say? I am paying high to my professors as compared to the market rates. That is why I'm having goodwill. Or I am giving better infrastructure. That is why I'm having goodwill. Or I am doing a big advertisement campaign. That is why I'm having goodwill. Or my staff is well trained. That is why I am having goodwill. No, sir. There are many reasons which make up the goodwill of an enterprise. So technically, allocating the cost becomes very difficult. So simple answer to it, whenever you are measuring the cost of internally generated goodwill, the answer will be 0. And self-generated goodwill does not fulfill the recognition criteria. The second recognition criteria, as you can see on your screen, the cost of the asset can be measured reliably. But sir, in case of self-generated goodwill, cost cannot be measured reliably. That is the reason why self-generated goodwill is not shown in the balance sheet. I hope this point is clear. Correct? Then I will talk about point number E. Sorry, E and F I was about to talk, not F and G. I'm sorry. E and F. F I already talked, internally generated goodwill. Now I want to talk about acquisition through government grants. Sir, AS12 repeat. If an intangible asset is acquired in the form of a government grant, then point number 1, it can either be for free. If it is for free, record at nominal value. If it is received at concessional rate, record the intangible asset at the concessional cost. And third, if after acquiring, you got some cash for it, you got some cash for it, then what we do, the cash subsidy that you have received will be deducted from the cost of intangible asset, right? Or you can defer the grant as the case may be. So that is the only point which is repeated over here. So we got a revision of our AS12 done over here now. So I'll repeat the point simply. Please understand, sir, if a grant is, if an intangible asset is received as a government grant, first point, if it is for free, record at nominal value. If it is for concessional rate, record at the concessional value. If any cash subsidy is received for any intangible asset, then subtract it from the cost of the asset. This is what we have already learned at our AS12 topic, government grant. Correct? Now, let us understand the cost of the intangible asset in various situations. Point number A, separate acquisition. Point number B, exchange for another asset. Point number C, issue of shares or securities. Sir, these 3 points are cut, copy, paste from AS10. Because, sir, in AS10 also these points were there. Yes or no? In AS10 also these points were there, and here also the same points get repeated. So what is different over here, sir? Only 2 points are different. Point number D, that is intangible asset arising from amalgamation, and point number G, internally generated intangible asset that is in the research and development phase. So these are the only 2 concepts which are actually different in this topic. And one last you will learn with respect to amortization. And so technically amortization is also goodwill only. So I can conclude one thing over here, that only these 2 points, that is how to calculate the cost of the intangible assets arising in amalgamation and how to calculate the cost of the research and development phase where an intangible asset is arised. These are the only 2 points which are different. Rest all topic is same. So let us now start with the first part, how to calculate the cost of an intangible asset which is separately acquired. Correct? Separate acquisition. Now what it says, if an intangible asset is acquired separately, if an intangible asset is acquired separately, the cost of the intangible asset, can usually be measured reliably. The cost of an intangible asset comprises of purchase price, including, that is plus any import duties and other purchase taxes, but in the bracket, other than those subsequently recovered by the enterprise from the taxing authorities, other than refundable. Because what is the meaning of this bracket? Refundable taxes should not be included. Because other than those subsequently recoverable by the enterprise from the tax authorities means it is refundable tax. And we have learned this point in AS2 also, in AS10 also. Refundable taxes should not be added. It should be excluded. Correct? And any directly attributable expenditure on making the asset ready for its intended use. So the same logic, sir. Any expense which is incurred to bring the asset to its present condition or location will be added to the cost of the asset. That same point. One example, directly attributable expenditures include, for example, professional fees for legal services. Means, for example, sir, you have written a book, correct? And now you want to get the book copyrighted. So technically you require a lawyer for that, right? So you pay, say, 5,000 rupees to the lawyer to get the copyright of the book done. So that 5,000 is incurred to get your copyright done. So that 5,000 plus whatever copyright fees you are paying to the government, that plus cost incurred to write the book, because that is also the cost incurred for acquiring the copyright. So all these things will be added together to form the cost of copyright. Right? And same logic can be applicable if you are purchasing the copyright from some other person. Basically, it is the publisher of the book. The publisher of the book will buy the copyright from the particular writer. Now, Chetan Bhagat writes a novel, sells it to the publisher. So publisher will pay him a hefty amount for his copyright. So the publisher will get the rights, print the book, sell it. So sometimes they pay a lump sum royalty, for using the copyright, or they pay royalty on the basis of per unit sold. But for, I think for Chetan Bhagat type of writers, they might be paying some amount first, lump sum also, and after that they will be paying some amount in the form of royalty for every book sold. The same is with our CA books also. Everybody might be knowing about T.N. Manoharan. His books are very famous for direct access. Snow White publication. Nobody knows Snow White publication. They know it by the name of the author. Sir, give me T.N. Manoharan direct tax. So such people, they take almost 50% royalty. Means 1,000 rupees is the price of the book. 500 goes to the publisher. Sorry, 500 goes to the author, and balance 500 will go to Snow White publication, because Snow White publication is there because of T.N. Manoharan. He came for a class in our previous institution. Okay, that I don't know, sir. He's Chennai based only, if I'm not wrong. Right, but even I used to use his books when I was doing my studies at final and inter level. And even when I used to take direct tax classes, at that time also I used to refer his books a lot. Beautiful books, very nice. Let's go ahead now. Yeah, he was former Canara Bank chairman also. He's a member in the taxation empanelment also of the finance ministry. He gives suggestion to the finance ministry. He's a person of great honor. Right, so let us go ahead now. So I've also written in short over here, cost is equal to purchase price plus non-refundable tax plus direct expense, but minus trade discounts and rebate. That is the last point. Any trade discounts and rebates are deducted in arriving at the cost. Now, can I say this same point you also learned in AS10? It is exactly same, no change. Right? Now the second point, exchange for another asset. Do you remember the concept of that commercial substance which I taught in AS10? Same logic, no change. Means I have one asset, this is my asset. I exchange this for acquiring an intangible asset. Correct? That is possible. Means I have a Mercedes-Benz car, I gave my Mercedes-Benz car and took up a patent. Correct? So that is possible. So here the logic is what? If there is a commercial substance in this transaction, plus the fair values of the assets are available, then the exchange can be recorded at the fair value of the asset given up or fair value of the asset taken up, whichever is more clearly evident. Exactly same. But sir, if fair value or commercial substance is not available, means any one of the two is not available, then the incoming intangible asset will be recorded at the book value of the asset given up plus or minus the boot money exchanged. The same point I have written properly, because here in the topic, in the module, they have just written an intangible asset may be acquired in exchange or part exchange for another asset. In such cases, the cost of the asset is determined in accordance with the principles laid down in AS10. So what principles are laid down? So same fair value logic and commercial substance logic. So same will be applicable here also. That is why I have written it separately. That is, if fair value and commercial substance is there, then record at fair values. But if any one of them is not available, any one of them means either fair value or commercial substance, anyone is not available, then cost of intangible asset will be book value of the asset given up. Just add plus or minus boot money exchange, because I was running out of space. That is why I did not write, or else I'll do one thing. I'll write it over here. Plus or minus boot money exchanged. Correct? And commercial substance is when you exchange an asset, after the exchange, will it help you to earn more as compared to your existing earning capacity? If yes, then commercial substance is present. But if even after exchange, sir, I'm earning the same thing, I'm not earning anything extra, then there is no commercial substance. Correct? Then issue of shares or securities. Sir, same as AS10 only. If say for example, I'm a company and I'm issuing my own shares for acquisition of an intangible asset, then the intangible asset will be recorded in my books at fair value of the shares issued or fair value of the intangible asset taken up, whichever is more clearly evident. And if I'm not wrong, we had solved one question in AS10. One question also we had solved, that some machinery was exchanged by issuing some 7,000 or 8,000 shares. The fair value of the share was 92 rupees, but the fair value of the machine was not available. So we recorded the machine, Tiger Limited sum. Yes, correct. Tiger Limited question. So we recorded the machinery in the books at the fair value of the shares given, because fair value of machine was not available. Same logic, copy paste from AS10. So technically the first 3 points, that is cost of an asset under separate acquisition, cost of intangible asset when exchanges for another asset is done, and cost of intangible asset when it is exchanged for shares or securities, is exactly same as per AS10. So anybody with any sort of queries with the first 3 points, or that self-generated goodwill point, or that government intangible asset acquired under government grant. So technically I've covered 5 points under measurement of cost. So anybody with any sort of query with these 5 points, please raise it immediately. Yes, Pooja.
Sir, what is this boot money, sir?
Boot money is the over and above exchange when you pay something. Means, for example, I have given my asset, plus I gave 500 rupees more. Then I got the intangible asset.
Oh.
That is called as boot money given. Or sometimes it is vice versa. You are giving an asset of higher value and taking an asset of lower value. So what that seller will do, he will give you the intangible asset, plus he will give you money on it.
Okay.
That is called as boot money.
Okay, sir. Thank you.
Yeah.
So boot money can be royalty also, no, sir?
Huh?
So boot money can be royalty also. It can be called
sir.
as
How
a
come?
similar.
No. How come royalty comes over here? Boot
Sir,
money has got
you
nothing
told
to
that-
do with royalty.
Sir, you told that extra money is paid on the part.
Are sir, if I am giving you an asset of worth 100 rupees, right, and you are giving me asset worth of only 80 rupees, will I accept it?
No, sir.
So I will ask, na, bhai, give 20 rupees more over and above this.
Oh, sorry, sir.
That is boot money. Now, if
Okay.
you go to buy a new phone, if you give your old phone, will he directly give you the new phone?
No, sir. Extra money we have to pay. Exchange plus.
Exactly.
Money.
That is boot money. That
Thank
is
you, sir.
boot money. Yes.
Sir, I don't know if the doubt is correct, but supposing let's say the fair value of the both asset, the asset that we are having and we are giving up, and asset that we are acquiring, both the fair value and commercial substance is known, but
It is
still
known. There
yeah.
or not there?
It is known, sir. It is there.
Okay. Fine.
But still, if we are paying up some boot money, then my question is that condition possible, sir?
Yes, it is definitely possible. It is
sir.
definitely possible.
Because
But yeah, please go on.
yeah, because we here the condition says that if it is not possible, then we will take the book value plus the boot money. But if both the conditions are satisfying, that is your fair value is also known and there is a commercial substance that is existing, then how will you record in the book, sir?
See, what will generally happen when you record at the fair value, always there will be a difference between the fair value and the book value. Because what will happen? New asset account debit to old asset. This is
Yeah.
the journal entry that you are going to pass.
Yes,
Correct.
sir.
Now the new asset you will be showing at the fair value. Say for example, the new asset is for 30 lakh rupees.
Hmm.
Correct. So new asset account debit 30 lakhs.
Hmm.
Correct. Now the fair value of the old asset is not 30 lakh.
Yeah.
Say it is only 20 lakhs. So you are considering the fair value of new asset.
Mhm.
Correct. But now actually the asset which goes out is recorded in the books at its fair value or its book value.
Book well.
Right. So my entry will be new asset account debit 30 lakhs.
Yeah.
Two old assets, say 20 lakh only is the book value. So
Okay.
two old assets, 20 lakh,
Yes, sir.
right? Plus 10 lakh I have to pay from my pocket.
Okay, sir.
So two bank, 10 lakhs.
Okay, sir.
This
The
is what
entry will be
entry
the
I
same.
pass.
The entry will
Yes.
be the same, but just that instead of book value, we'll write fair value.
Exactly. We'll be writing the fair value of the new asset.
New asset.
Because generally the fair value of the new asset might be greater than the fair value of the old asset.
Yes. Yes, sir. Understood.
Or sometimes they may have an equal type of fair value also. And if it is equal, then in that case, the difference will be adjusted to the profit and loss account. Means, say for example, you are not paying any boot money.
Hmm.
You are not paying any boot money, and new asset comes in, old asset goes out. So fair value of the new asset account debit to book value of old asset,
That's
and
all.
difference goes to P&L. That is a profit or loss on exchange.
Yeah.
So that can also happen. Correct?
Yes, sir.
Yes. Yes, sir. Raj, right? Raj Kiran. No, it
Sir,
is
Ramakrishnan.
Ramakrishna. Sorry. Yes, sir.
Sir, when should I add or when should I subtract the boot value from the WTV of the asset, sir? I cannot
So
understand.
generally, when you are recognizing at the book values,
Okay, sir.
generally when you are recognizing at the book values, then the boot money point comes in.
Sir, when should I add, sir? Whether I give the cash or
Acha,
I
okay.
receive the cash, sir?
See, when you are paying cash, it is added because that increases the cost of your asset. And
Okay,
when
sir.
you are receiving cash means it is reducing the cost of your asset. So when you pay it, you add it. When you receive it, you subtract it.
Okay, sir. Thank you. That's all, sir. Thank you.
Okay. Yeah. Now let us go to the next concept, that is intangible asset arising from amalgamation in the nature of purchase. Now I think you people are not aware about amalgamation because amalgamation topic is not yet covered for you people. So it is something new for you. So I just have to explain this point first, and then I can go with my concept. Because directly, if I go with the concept, people, I think it will be a bouncer for you. Now, sir, amalgamation. Generally, what is amalgamation? Sir, one company which is taking over the another company, and the existence of another company will be no more. Means A Limited takes over B Limited, and B Limited gets liquidated. B Limited gets liquidated. That is one way of amalgamation. Or second way of amalgamation is Vodafone Idea. Vodafone Idea Limited got merged together and formed a new entity. So now we don't have a separate entity called as Idea Limited, nor we have a separate entity called as Vodafone Limited. We have both together as Vodafone Idea Limited. So that is also considered as one way of amalgamation. That is when two companies merge together and form a third entity, right? But here, yes, many banks. Now, one of the biggest amalgamation took place was Bank of Baroda taking up Dena Bank and Vijaya Bank. So Vijaya Bank and Dena Bank got amalgamated with Bank of Baroda. Many public sector banks are taking place. So let us not go with the examples anymore now, because example is not important. The concept is important. So generally, amalgamation can take place under two ways. Accounting for amalgamation, or I can say amalgamation can be done in two methods, either merger method or purchase method. Now, sir, when I talk about merger method means the selling companies, each and every asset and liabilities will be taken over by the buying company. So in this case, goodwill does not arise because whatever is the value of the company, the same amount you pay to the company, not even 1 rupee more or 1 rupee less. If the value of the company is 500 crores, you will pay 500 crores and acquire all the assets and all the liabilities at the book values itself. So technically, no extra payment or no lesser payment arises. So merger method is not our cause of concern. Our cause of concern is purchase method. Because under purchase method, point number 1, we may not take up all assets and liabilities of that selling company. Point number 1. And point number 2, the values that we are paying for purchasing the assets or liabilities can be market values. So if they are market values, so technically the point is we can either pay them extra of what we are getting or we can pay less than what we are getting. Means, for example, the assets that we take over of that company, which is called as NATO, net assets taken over, that is nothing but assets minus liability. Net assets taken over, and this is the value of the company. And purchase consideration is what you pay from your pocket. And generally, the assets and liabilities are valued at the market rates. So it is possible that you may either pay them extra or pay them a lesser amount. Now, say for example, if the purchase consideration that you are paying is greater than the value of assets that you are going to take up, means, for example, you are paying them 120 rupees, but the assets that you are taking up from the company is worth only 100 rupees. So the difference of rupees 20 is goodwill. And sir, this goodwill is not covered by AS 26, it is covered by AS 14. So difference 20 rupees is goodwill covered by AS 14. So this is that goodwill arising on amalgamation. And goodwill can arise on amalgamation only in case of purchase method. It can never arise in case of merger method. Because in merger method, purchase consideration and assets takeover value will be same. So goodwill can never arise. So here the logic is what? You are getting the assets worth 100 only, but you are paying 120, means technically you are paying 20 rupees for the name of the company. You are paying 20 rupees for the name of the company, and that is goodwill. But in the second situation, the purchase consideration, what you are paying is less than the assets that you are taking up. So this is a profitable situation for you. Means you are paying only 90 rupees, which is less than the assets take over 100. So the difference of rupees 10 is a profit, that is capital reserve. I hope you get this point. So sir, why are you teaching this to us? Sir, because my one point is related to this goodwill logic. And for that reason, I have to teach all these things to you, because your amalgamation chapter is not done. If that topic would have been done in your batch, I would have not even talked about all these things, because you would have already had the knowledge about it. Right? So now I am taking you back to my concept. Correct? So simple logic is what? Sir, amalgamation under purchase method. If we are paying more and getting less, the difference is goodwill accounted as per AS 14. And if we are paying less and the value of assets that we are getting is more, then technically it is a situation of profit for us, capital reserve. Correct? Now, again, going back to our next point, if anybody wants to record this, you can please take a screenshot of the same. This will be again taught to you when you are doing amalgamation chapter. So just for a reference, you can just take a note or just take a screenshot of the same. I'll change the screen now. Correct. Yes, Dikshit.
Sir, some points has missed in that, sir. That means
Sir, I'm
I
not
didn't
on
take-
detail only, sir.
no,
Because
no,
that is
sir.
not my area of concern.
No.
I know there are 5 points to state whether it's a merger method or not. And if those 5 points are not covered, then it becomes purchase. Then it becomes purchase method. There are conditions that the purchase consideration should be paid off only in the form of shares. Cash cannot be paid. All the assets and liabilities will be taken up. The business of the selling company should be continued by the buying company. Cash can be paid only for the fractional shares. Statutory reserves should be maintained as it is. Other reserves can be distributed. These are all points, but sir, this is not the time to discuss those, because that is not our area of operation now. Our area of operation is to understand what is the logic of the intangible assets arising in amalgamation. Okay, sir, shall we go ahead?
Okay, sir.
Okay, now please understand intangible assets arising from amalgamation. Now, sir, here, if goodwill is arising, when amalgamation is done in the nature of purchase, goodwill is accounted as per AS 14. But apart from goodwill, there can be some other intangible assets also which can arise. So how to record them and at what value it should be recorded is what we are learning over here. Correct? I'll repeat my point. If goodwill arises in amalgamation under purchase method, that goodwill is accounted by AS 14. But other than goodwill, if any other intangible asset arises, then it will be recorded as per AS 26 also. And at what values it should be recorded is what we are learning now. So let us try and understand. This is tricky. Huh? This is very tricky. So everybody please focus properly. Don't do anything here and there. And sir, don't write any comments in between now. For the next 10 minutes, I want everybody to purely focus over here. Right? Now, point number 1. Sir, as a buying company, I can record the intangible asset in my books only if it meets the asset recognition criteria. Even if the selling company had not recorded that intangible asset because it did not meet the asset recognition criteria for them, but it is meeting for us, we can record it in our balance sheet. That is point number 1. So even if the intangible asset was not recorded in the balance sheet of selling company, we can still record it in our balance sheet if and only if it meets the asset recognition criteria. Point number 1. Point number 2, at what value? Generally, fair value. You have to consider the fair value of that intangible asset. So if fair value of that intangible asset is available, you can definitely record at the fair values. Right? But if fair values are not available and it is not possible to ascertain the fair value, then sir, in that case, let it be merged with the value of goodwill only. Now people are confusing. Let it be merged with the value of goodwill. So not able to get this point. Please see numerical point. Say purchase consideration is 50 rupees. Correct? Net asset taken over is 40 rupees. So can I say 10 rupees extra that you are paying is goodwill? Correct? Now assume you come across an intangible asset while acquiring all the assets and liabilities of that enterprise. But that intangible asset is nowhere included in this 50 rupees. right? Because that was not there with that company. They have not shown it in their balance sheet. But you are coming across that some intangible assets are getting generated. Say, for example, some customer data gets generated, right? So that is also an intangible asset. Some useless patents for that company which never met the recognition criteria, but it is a very useful patent for you. So for you, it meets the recognition criteria. So for the selling company, if recognition criteria was not met, they might have not shown in their balance sheet. But you can show it in your balance sheet because you meet the recognition criteria. Yes or no? So technically, in this 50 rupees, that intangible asset is not there. Correct? Now, if you know the fair value, if you know the fair value, you can record it at the fair value. Correct? But if you don't know the fair value, then it has to be recorded at 0. Means technically that intangible assets value remains in the value of goodwill only. Because say the fair value of that intangible asset would have been 3 rupees. Then can I say your purchase consideration would have become 53 and net asset taken over was 40? Yes or no? One minute, something is going. Okay, sorry, my mistake. Purchase consideration remains 50 only, but asset will become 43 because that intangible, actually I showed the wrong pointer, that intangible asset is not covered in the net assets taken over because they did recognize it, but you are going to now recognize it. So technically for you, the net asset taken over now becomes 43 and the goodwill figure becomes 7. So goodwill has reduced because another intangible asset comes into picture. But if you don't know the actual value of this intangible asset, then can I say goodwill would have been remained at 10 rupees only? So technically, if the fair value is not known, then let it remain in the value of goodwill only. Means don't show that asset separately. Let it be there with goodwill 10 rupees. But when you know the fair value that it is 3 rupees, then show that asset 3 rupees separately and goodwill 7 rupees separately. That is what the point says. Are you understanding this? So if the fair value is not available, don't record the asset. Let it remain merged with goodwill. This is how it remains merged with goodwill. That is one point. Correct? Then one more point. If active market is available for intangible asset and fair value is also available, record intangible asset at fair value and it can increase the capital reserve. This is something tricky. Huh? I'll take back to the theory first. I'll take back to the theory and then I'll come to the examples which I've already written. I'll do that only. Now what it says, a transferee recognizes an intangible asset that meets the recognition criteria. Transferee over here is nothing but the buying company. The buying company can recognize an intangible asset that meets the recognition criteria, even if that intangible asset had not been recognized in the financial statements of the selling company, that is transferor. I told you this point earlier also. Even if the selling company is not recording, the buying company can record in its book if it meets the recognition criteria. Right? Second point, very important. If the cost, that is fair value, of an intangible asset acquired as part of an amalgamation in the nature of purchase cannot be measured reliably. That asset is not recognized as a separate intangible asset, but is included in goodwill. I just now taught you this point. If fair value cannot be ascertained, then don't record the intangible asset separately. Let it remain with the goodwill itself. Just now we saw it, right? But one more important point. If no active market exists for an intangible asset, its cost reflects the amount that the enterprise would have paid at the date of acquisition for the asset in an arm's length transaction between knowledgeable and willing parties based on the best information available. The cost initially recognized for the intangible asset in this case is restricted to an amount that does not create or increase any capital reserve arising at the date of amalgamation. So this point is very, very important and very tricky. Now what they say, sir, there are two possibilities. Possibility number one, for your intangible asset that you are acquiring in case of amalgamation, you have an active market for it. So when active market is available, fair values are also available, and they are correct fair values. They are trustworthy fair values. So in that case, AS 26 says you can definitely record it at the fair values. And even if after recording the asset, it creates a capital reserve, we are having no problem with it. Or if it is increasing the capital reserve, we are having no problem with it. So by recording the intangible asset in your books at the fair value, because active market is available, you can create or increase capital reserve. Means if earlier you are showing goodwill, after recording the intangible asset, goodwill can now become capital reserve also. Or if there is existing capital reserve, it can be further increased also. No problem at all. Why? Because active market is available. So please understand the first example. Sir, net assets is 50 rupees and we paid only 40 rupees. Correct? So there is a capital reserve. Already there is a situation of capital reserve 10 rupees. Now, if intangible asset has an active market with fair value, record it at the fair value and capital reserve can be increased. It can be increased. That is, fair value of intangible asset is 15. So, sir, now what will be the net assets taken over? Sir, it will be 50 rupees plus 15 rupees of the intangible asset that is getting acquired. So net asset will become 65 rupees. But you are paying only 40. So technically 25 rupees. So here we have increased the capital reserve. That is allowed, sir. No problem. Reason, active market is available. I hope you understand my point. Correct? But if active market is not available, then you can record the intangible asset. You can record, still you can record. Active market is not there, but still you can record the intangible asset. But see to it that capital reserve is not increased. Nor it is creating a new capital reserve. So, sir, only one conclusion over here. You can record an intangible asset without active market if there is only the situation of goodwill, and that goodwill will become zero, and in front of that intangible asset will be recorded. Because if it is a case of capital reserve and you still record the intangible asset which is not having a market, then it will lead to increased capital reserve which is not allowed. Because this is the point that says, if no market exists, then the initial recognized, the cost initially recorded for an intangible asset in this case is restricted to an amount that does not create or increase any capital reserve arising at the date of amalgamation. So first, please understand this example. Please understand this example. If active market is not there, then intangible asset can be recorded at a value. It can be recorded at a value maximum, which will make goodwill zero. Means technically, you will replace the value of goodwill with the value of the intangible asset. So you will give the value of goodwill to the intangible asset. So goodwill becomes zero, and in that place, other intangible asset comes, and no new capital reserve is recorded or existing capital reserve is increased. Just have a look at this example. Net asset is 50 rupees and you are paying 60 rupees as purchase consideration. So 10 rupees over here becomes goodwill. Correct? 10 rupees is goodwill. So intangible asset can be recognized as the maximum value of rupees 10. So goodwill will become zero and no new capital reserve will be created. But if you want to record your intangible asset at 15 rupees, then what will be the problem? The problem is 10 rupees of goodwill will go away and 5 rupees of capital reserve will come. And you cannot show a capital reserve if there is no active market available for an intangible asset. And the logic is very clear. If you don't have an active market, the value at which you are showing is not a trustworthy fair value. So people can record any fair value of their choice and unnecessarily increase capital reserve. So AS 26 is very clear. AS 26 says, if you have an active market, record the intangible asset at fair value. Even if it is creating capital reserve or it is increasing capital reserve, no problem. But AS 26 also says, if boss, active market is not there, then you can record the intangible asset only in the case of goodwill situation. Because in capital reserve situation, if you record the intangible asset at any value, your capital reserve will increase. And increasing the capital reserve or creating a new capital reserve is not allowed. Reason, active market is not there. I hope you are getting this point. Means if this is the case, net asset taken over is 40, purchase consideration is only 35. So 5 rupees is capital reserve, correct? In this situation, you cannot record an intangible asset without any active market. Because if you try to record, what will happen? Capital reserve will increase. Means say for example, I'm trying to record an intangible asset without any market, active market at 3 rupees. So what will happen? Net asset will become 3. Purchase consideration is still 35. Sir, capital reserve is increasing to 8 rupees. So in this case, I cannot record the intangible asset because it doesn't have an active market. But if it is a case of goodwill, then I can record. But at what value? Only maximum to the extent of goodwill. So this is the different point as compared to AS10. In AS10, this point is not there. And I wonder, till today, the institute has never asked a question on this point. But sir, it is a head-scratching point in exam if you don't remember the basics. So how to sum it up? Sir, very simple. First point. If the fair value is not available, at all, don't record it. Second point. If active market is there, definitely you will have a fair value. Record at the fair value. At whatever value, no problem. Whether it is creating goodwill, whether it is creating capital reserve, increasing capital reserve, no problem. Second situation. And third situation, sir, active market is not there. So technically active market not there means fair value will also not be available. But still I want to record the asset. I will try to find out some value and I will want to record it. So sir, if you are in the situation of goodwill, then only such intangible asset can be recorded, but only to the extent of value of goodwill. But if you are already in the situation of capital reserve, then sir, asset cannot be recorded, because in such case, what will happen? If there is no active market available, then you cannot increase the capital reserve or create any new capital reserve by recording the intangible asset. So these are the 3 points that you need to note down. Correct? Let us go for the next and the last part, that is internally generated intangible asset, that is through a research and development phase. Now this is a very common thing which many enterprises take up. They do their own research and development in-house, and they try to develop or come out with a new technology or a new product which they can definitely sell it to others in the market on royalty basis, obviously, or they can use it in their own business. And the best examples would be the mobile phone companies, because mobile phone companies keep on doing research and development and try to bring in every 6 months or every quarterly some new technology. And Vivo, Oppo are number one for research and development across the globe. Vivo and Oppo has the best research and development team, and they generally come out with every new type of things in every 3 or 6 months. Whatever you call it as. Selfie has been now become famous only because of Oppo and Vivo. And no wonder how ugly you are, but Vivo and Oppo selfie, you become super handsome and super beautiful. Vivo and Oppo, very famous for, and it will even what did you say? It will hide all the pimples on the face also. That wonderful Vivo and Oppo is. Yeah, it will make the crow white. Yes, correct, sir. But I don't like Vivo and Oppo phones. I am not a fan of Vivo and Oppo at all. I don't know. I never like those phones. Never, because they are doing so much advertisement. So much advertisements. That is why I started hating. Sometimes having so much advertisement also, you start hating the product. OnePlus is also their brand only. OnePlus, Oppo, Vivo, all three are under one banner. BBK Technologies, China. Those are all China phones only. But manufacturing in India now. So let us go ahead. What is the accounting treatment? Now please understand, sir. When you are internally generating an intangible asset, basically there are two phases. A research phase and a development phase. A research phase is where you come out with something new, right? But that has to develop further to become a marketable finished product. So development phase is what? Development phase is further working on the research to make a particular product a marketable product. So technically, two types of expenses you incur: expenditure on research and expenditure on development. AS26 is very clear. Research being a recurring nature item means you do continuously go on researching new things. So AS26 says research is a recurring nature item and it has to be expensed out immediately in the profit and loss account. Even if any intangible asset arises in the phase of research only, means without doing development, in a research phase only, an intangible asset arises. Still, it cannot be capitalized in the books as an intangible asset. It has to be written off in the profit and loss account. As simple as that. But sir, when I talk about development phase expenditure can be capitalized as an intangible asset in the books if you can fulfill the following 5 conditions that you can see on your screen. Means in simple terms, those 5 conditions are called as asset recognition criteria. So the day when you are incurring development expenses and after some time the asset meets the recognition criteria. So from that day, when it has met the recognition criteria, you can consider it to be capitalized in the books of accounts. Means, sir, there is one small doubt in development cost. The entire development cost sometimes cannot be capitalized because you start your development phase, but the asset meets recognition criteria, say after 2 months. So technically for the first 2 months, whatever expenditure you incurred on the asset does not meet the recognition criteria. So for expenses for 2 months, whether it is for development, still will be debited to P&L account. And from the 3rd month, when the asset has actually met the recognition criteria, expenses that you start to incur from 3rd year and so on shall be capitalized. I hope you are getting my point. So point number 1, research expense always debit to P&L. Development expenses can be capitalized only if the asset meets recognition criteria. So any development expense prior to asset meeting the recognition criteria shall be charged to P&L. But once the asset has met the recognition criteria, after that, whatever further development expenses you are incurring shall be capitalized as the cost of intangible asset. But sir, what are the conditions for recognizing the development expense as an intangible asset? Sir, there are 5 conditions. So let us understand these 5 conditions. So what they say, I'll read it from here. Okay. I'll start. To assess whether an internally generated intangible asset meets the criteria for recognition, an enterprise classifies the generation of an asset into 2 parts, that is research and development phase. If an enterprise cannot distinguish between the research and development phase, the entire cost is considered as the research cost. So this is one important point, but in question solving, this is not considered. What AS26 says, if you cannot bifurcate between research and development phase, whatever cost you are incurring will be considered as research cost only and will be expensed to the profit and loss account. But in question solving, we do something different. In question solving, we have to show all the amortizations and all. That is why we always consider everything as development cost only. In question solving, we do something different. But what is written in the standard, they say, if research and development cannot be bifurcated, consider entire cost as research cost. Right? Now, research is the original and planned investigation undertaken. Sir, this is the book definition. I'm not concerned with the book definition, sir. In simple terms, I can say research is that phase where you come out with some new technology. Right? When you do research, you come out something with new, and development is the further stage where the output of the research is further development is that phase where the research is further processed and converted into a final marketable product. So what AS26 says, expenditure on research or on the research phase should be recognized as an expense when it is incurred. So expense is out immediately. But what it says with respect to development, let us see. Now this is the book definition of development. I'm not concerned with the book definition, sir. I've already told you what development phase is. It is the further processing of the output of research to make it a final marketable product. So what it says, an intangible asset arising from development or from the development phase of an internal project should be recognized if and only if an enterprise can demonstrate all the following conditions. Demonstrate means fulfill all the 1, 2, 3, 4, 5, 6 conditions. So if these 6 conditions can be satisfied, then I can say that the asset meets recognition criteria and development expense can be capitalized in the books of accounts as an intangible asset. So what are the conditions? First, the technical feasibility of completing the intangible asset so that it will be available for either using it or selling it. Means, sir, you have all the technical feasibility, means you have all the technical skills to complete the development. Point number 2, you have the intention to complete the intangible asset to either use it or sell it. Third, you have the ability to use it in your own business, or you will definitely find a customer to whom it can be sold. Point number 4, the intangible asset which is going to get generated will have future economic benefits for your enterprise, either by using the intangible asset in your business and manufacturing products out of it and selling those products, or by selling the intangible asset itself. So you can have economic benefits in 2 ways. First, using the intangible asset in your business, and with the help of that intangible asset, you will manufacture some goods or services, you will sell it, you will earn economic benefits. Or else, you can directly sell off your intangible asset to other parties and earn revenue from there. Point number 5, you have, now sir, point number 5 actually a repetition of point number 1 only. You have adequate technical, financial and other resources to complete the development, to either use it or sell it. And lastly, the ability to measure expenditure, means in short, the cost incurred on the development phase can be measured reliably. So these are the 6 points that an enterprise has to demonstrate, after which you can say that yes, the asset meets the recognition criteria and you can capitalize the development cost as the cost of intangible asset. So in simple terms, how you will say, sir, I have technical feasibility to complete, I have all the intentions to complete the development. Sir, after development, I am having the ability to use it in my own business or sell it. There is future economic benefit associated with this intangible asset that we are going to get. Correct? I have all the technical, financial and other resources available to finish my development. And lastly, I can calculate or I can measure the cost of the development reliably. So if these conditions, 6 conditions are satisfied, capitalize the development cost as an intangible asset. I hope you understand the 6 points. And sir, in exam, if a question from here, you need not write all the 6 points because the answer becomes too lengthy. You can simply state that an intangible asset arising from development can be recognized in the books if it fulfills all the conditions as per AS26. That's it. Don't write all the 6 conditions in exam and unnecessarily waste your time. Because for 5 marks, these all conditions plus you have to write the given situation, the answer becomes too lengthy. So you can just write the intangible asset arising from a development phase can be recognized in the books if an enterprise can demonstrate all the conditions given as per AS26. Full stop. That will be more than enough. Right? So here we complete with the measurement of cost. Here we complete with the measurement of cost. Anybody with any query with respect to research and development, you can please ask. Research and development, any query you can ask. If not, I will proceed. I think it is clear, nobody is raising any query. So we'll go ahead. Research, yes, always debit to P&L. No second thought. Research cost, always debit to P&L. And development cost, generally capitalized, but after it meets the recognition criteria. So sometimes it meets the recognition criteria at the beginning itself. So all the development cost gets capitalized. But sometimes the development phase can go for 12 months, for example. First 3 months, it is not meeting the recognition criteria. So technically expenses incurred for first 3 months means in the first 3 months, you cannot demonstrate all those conditions. So for first 3 months, no asset recognition, debit to P&L. But finally in the 4th month, you have met the recognition criteria. So technically from the 4th month to the 12th month, whatever expenditure you are incurring for development becomes the cost of intangible asset. Because from the 4th month, you can fulfill or you can demonstrate all the conditions above given.
Hello, sir.
Yes, sir.
I want one clarification regarding this one point in research phase. which says
Yes.
no asset to be recognized when it is in the research phase, right? So what does it mean actually?
Even I told this point, I already told this point, even if an intangible asset gets generated in the research
Okay.
phase, means no need to develop
Okay.
further. In the research
Okay.
phase only, you got one intangible asset,
Right.
but still it cannot be capitalized because it is research phase.
Okay, so we can't consider it as a project that's done. Okay.
Means you
Thank
have
you.
an asset, but you cannot capitalize. You have
Okay.
to debit directly to P&L.
So are there any assets which do not require any development, which is just based
Sir,
on
I
some
cannot
research things?
technically know because I am not a technical
Okay.
person, sir.
Okay.
Scientists can
Okay.
answer, sir. We are
Okay.
here
Okay.
just to account.
Yeah.
So
Yeah. Okay,
technically,
sir.
the technical team of our enterprise, the research and development team of our enterprise will always have an accountant with them. So they
Okay.
will update their, what we say, whatever they are doing new, they will be updating their accountant. And accountant is the person who will decide
Whether to
whether
disclose it in such a way or not. Okay.
yes,
Okay.
how to record it, like what is still what the research phase is going on, and then what type the development.
Do we
People are
get
asking
questions
exam.
based on this in examination by any chance, or it's not relevant?
Yes, questions are there. Many questions comes on R&D. We are solving some questions on R&D also.
Okay.
We'll be
Okay.
solving.
Okay. Okay, sir. Thank you, sir.
Yeah. Next point is subsequent expenditure. Now somebody is asking me, give the example of research and development expense. Now what example will I give? Take Vivo Mobile. Vivo does lots of research. Pop-up camera research, OLED display, in-display fingerprint research. So expenses are incurred on all new things in technological world. That is called as research and development expenditures. When they want to find something new. Now, rollable phones are coming. Screen, press a button, your screen will expand and your screen will close. Now, COVID vaccine, yes, COVID vaccine research and development, huge research and development expenses are incurred. And finally, they met the asset recognition criteria once the vaccine was successful. Bharat Biotech and Poonawalla, Serum Institute. These two people, their vaccines are now used in India. And they are saying that vaccines made in India are safe. So let it be safe. Because my papa has got an appointment on 28th of March to get a vaccine shot. He's 50 plus, so yeah, that now they are giving vaccine to 45 to 60 years. So he's going to get a vaccine shot. So let's go for the next one. Subsequent expenditure, sir, cut, copy, paste, AS10. Means if after incurring a subsequent expenditure, the future economic benefit of the asset increases beyond its original capacity of earning, plus the cost of the asset, the subsequent cost can be measured reliably, then the subsequent cost can be capitalized. Sir, because here these are intangible assets. So increasing the efficiency of the intangible asset will not be a correct word. So the correct word should be what? It is increasing the earning capacity of the intangible asset. Because for tangible assets, you can say, yes, efficiency is increased. But for intangible asset, how can I increase the efficiency? So I am talking about the efficiency of earning. So if you are incurring any subsequent expenditure on any of your intangible assets, and it helps you to earn more as compared to what you are earning currently, plus the cost that you have incurred can be measured reliably, then in such cases, the subsequent expenditures can be capitalized to the cost of the asset, or else please debit it to the profit and loss account. Means I can give you an example. First, under display fingerprint technology had come, but it used to take 3 to 4 seconds to unlock your phone. But then Vivo people did some further development on it, and they came up with some new technology where now it unlocks your phone in less than 1 second. So new development was done, and because of this, they might have spent subsequent cost on the existing technology that they have. And this new technology is helping them to earn more as compared to the old technology, because people started hating under display fingerprint because it takes a lot of time. That iPhone wala is good button, or that backside you have that button, you put your finger and phone gets unlocked quickly. But under display was a new technology. Initially, it was not that great, but now under display works super. For OnePlus phones and Samsung phones, you press it and it gets unlocked. So new technology, they're spending a lot. That is subsequent expenditure. So will it help them to boost their sales? If yes, capitalize. No, sir. I have done subsequent expenditure, but not earning anything extra as compared to the original earnings. Then, sir, please put it to P&L. Same like your fixed assets, as you learned for AS10. Right? Let us go ahead now. Measurement subsequent to initial recognition means how is your asset to be recorded in the books of accounts. So as you can see, I've simply drawn one balance sheet asset side format. So this is how your asset is shown in the balance sheet after initial recognition. Means initial recognition means first time when your asset gets recorded, it always gets recorded at the cost. But after that, on every balance sheet date, you subtract from it the accumulated amortization, which is nothing but the accumulated debris only, minus accumulated impairment losses. And whatever goes to the outer column is called as your carrying amount. This is called as the carrying value, or you also call it as the book value. Right? So this is the simple concept that in the balance sheet, the asset is shown at the carrying value after initial recognition. That is cost minus accumulated amortization minus accumulated impairments. You get the carrying value. Now we have come to the end of the theoretical content. In the next 10 or 15 minutes, we'll be winding up with the theory part. And then we'll only disclosure part, I think we'll be covering it tomorrow. We have to solve some questions after this. Now, sir, amortization. Sir, amortization is nothing but simply depreciation only. And the definition is also similar to that of depreciation only. So what is the point? Sir, they say, first the definition. Amortization is the systematic allocation of the depreciable amount of an intangible asset over its useful life. Means over the useful life of the asset, you write off its cost. And writing off the cost over the useful life is nothing but amortization. Means, sir, it is depreciation only. Only the name is different. The depreciable amount of an intangible asset should be allocated on a systematic basis over the best estimate of its useful life. So useful life is always estimated. But sir, there are some intangible assets which gets a fixed life. For example, when you go for a patent, the government can give you a patent for 5 years. So after 5 years, you have to renew your patent. And sir, generally when there is a patent with respect to some technology, anyhow in the 5 years time period, it is going to be outdated because some new technology will come in. But for some formula of some food, or now for example, KFC, a KFC has a worldwide patent of their secret spices or whatever that uncle is using in that chicken. I don't know what he uses, but there is some patent taken for it, worldwide patent. And sir, for food industry, the patent remains for a very long period of time. Now, Pepsi and Thumbs Up. I am drinking Pepsi and Thumbs Up from last 28 years. And sir, the taste is the same. It has never changed from last 28 years. And I don't think so it is going to change any soon. Because people are used to the taste. And even if you drink one sip of Thumbs Up now and if the taste is changed, you can feel the difference immediately. So generally in food industry and all, the patent of the formula of the how to make the food remains for a long term. But in technological industries, patent gets outdated in 3 or 4 years or sometimes in 1 year also. So what they say, amortization should commence when the asset is available for you. Same like depreciation. Depreciation is charged from the day when asset is ready to put to use. Here also same logic. When the intangible asset is ready for its use, you can start charging amortization. estimate of the life of a useful life of intangible asset generally becomes less reliable as the length of the useful life increases. Means what they say is, don't unnecessarily increase the estimation of the life of your intangible asset, because generally now your intangible assets don't have a longer life, they have a shorter life. So always try to estimate a shorter life only, because longer life is not justified. That is why AS 26 adopts a presumption that the useful life of an asset should not go beyond 10 years. This is an assumption, or you say you have to follow this point as per AS 10. The maximum time period for amortizing any asset can be 10 years, but if you have a lower life, amortize in the lower life. But they also say that in some cases there may be a persuasive evidence that the useful life of the intangible asset will be greater than 10 years. So if you have a proper justification, then you can amortize for a time period greater than 10 years. Choice would be yours. So if you have a patent of 15 years, so you have a justification of 15 years, write off or amortize in 15 years. But if you don't have a justification, you cannot go beyond 10 years. Even if you have wrongly gone beyond 10 years, you have to give a retrospective change and bring it back as if you're doing for 10 years only. We have a question also on this. We'll be solving it soon. Then, amortization methods, so you can either follow SLM or WDV method, or you can also amortize on the basis of expected future economic benefits. Now, what is the logic of expected future economic benefits? Sir, purely on the basis of what inflows you are earning from that asset, in the same proportion of your economic benefits, you will amortize the particular asset. But sir, generally, in income tax section 32, that is for depreciation, Income Tax Act has clearly said that depreciations can be charged on intangible assets at 25% WDV method. So technically, everybody in their books of accounts will follow straight 25% WDV method, because it is same as income tax. So nobody goes for SLM or on the basis of economic benefit. No, because Income Tax Act has given 25% WDV method on intangible assets. So sir, even if I am having an intangible asset, that is software in my balance sheet, I charge directly at 25% WDV method. Who is going to follow a different method when income tax is telling you to follow this method? So I never follow a different method. I follow the same method and same rates given by the Income Tax Act, so that I don't need to calculate my depreciation 2 times. Because then accounting depreciation will be different and taxation depre will be different. So who has the time to do two depreciations? That is why directly follow as per income tax only. I'll be showing you one example based on this, but before that, review of amortization period and method. Review of amortization period and amortization method is the same that you have also learned in AS10. There you learned review of estimated life and review of depreciation method. Same point arises over here. Means sir, at every financial year, at the end of every financial year, please check the life of the the remaining life of the intangible asset. And if there is any change in the life, please accordingly change the amount of amortizations. And if, say for example, you are following SLM method, but now you feel that no, SLM method is not correct for our enterprise because we are not having equal benefits. Our benefits are now reducing. So better to shift to WDV method. That is called as review of amortization method. So at every financial year end, you should review the amortization period and method both. So what it says, the amortization period and the amortization method should be reviewed at least at each financial year end. If the expected useful life of the asset is different from the previous estimate, the amortization period should be changed accordingly. Means if you thought asset will work for 5 years, but now you see that no, it cannot work for 5 years, it can work only for 3 years, then accordingly you have to change the life to 3 years. So when you change the life to 3 years, your amount of amortization should also be in 3 years. Means asset should be written off in 3 years only. You cannot wait for 5 years. So if there has been a significant change in the expected pattern of economic benefit from the asset, then the amortization method should also be changed to reflect the pattern. That is what I said. Sir, earlier we thought every year we are going to get equal benefit from the asset. So we started using SLM method for amortization. But sir, after 2 or say 3 years, we understood that now equal benefits is not possible every year. The benefit will decline from the 4th year. Decline. So sir, don't amortize using SLM. Shift to WDV and start using WDV method from the 4th year. And sir, changing the life of the asset or changing the method of amortization is always a change in accounting estimate as per AS5. It is not a change in accounting policy. It is a change in accounting estimate. I hope people are clear with this point. Now, please try and understand what do you mean by amortizing on the basis of expected future economic benefit. Sir, for this, I will show you one example, so you can clearly understand this. Now, sir, this is one small example. We have a patent with a life of 5 years, correct? Cost of the patent is 1600 rupees. Cost of the patent is 1600 rupees. And the pattern of economic benefit is given to you. The pattern of economic benefit is given to you is nothing but your cash flows. Means every year, what amount of cash flows are expected from the asset. So we say in year 1, 400 rupees we are expecting. In year 2, 500. Year 3, 750. Year 4, 350. Year 5, 200. And total benefit that we are expecting is 2,200 over a period of 5 years. So, sir, simply amortize on this in this pattern. Means I can even conclude that this is very much similar to your production units method or machine hour rate method. Similar to that. So, what will be depreciation or amortization for first year? Sir, 1600 is the cost multiplied by 400 that you can earn in the first year divided by total expected earnings, that is 2,200. So 1600 multiplied by 400 divided by 2,200, 290 rupees or 291 rupees first year amortization. Then second year you are expecting 500 rupees earning. So 1600 multiplied by 500 divided by total expected 2,200. Answer gets 364 rupees. And so on we have calculated for all the 5 years. Right, this is called as amortizing using the pattern of economic benefit. And sir, also understand, say in the first and second year, the pattern is same. But in third year, what if 750 turns out to be 850? Can it possible? Yes, sir, definitely possible. So you have to amortize using 850, but then see to it, when it is becoming 850, the total will become 2,300. And only prospective effect, whatever happened in first and second year, let it be. Change from this year. So technically for third year now, what will be happening? 1600 multiplied by 850 divided by 2,300. Right? And say in the fourth year it remains same at 350, no problem. But in fifth year it becomes 300 then. So for fifth year, what will happen? If this becomes 300, total becomes 2,400. So for fifth year, what you will show? 1600 into 300 divided by 2,400. So technically your asset will get completely written off. Full 1600 will be written off, not to worry at all. So these are estimated cash flows. These are estimated pattern of economic benefit, and this pattern can change. So if it changes, no problem. That particular year's cash flow will change. So always remember the total will also change. Don't just change this amount and keep the total amount same. Total amount will also change. If this increases by 100 rupees, the total will also increase by 100 rupees. 2,200 will become 2,300. Clear with this point? Correct? Simple. No rocket science. I can link this with your CA foundation, depreciation on machine hour rate or depreciation on production unit method, same like that only. And sir, this pattern of benefit will be given in the question, not to worry. It will be given in the question. Don't worry at all. Right? I'm changing the screen now. Yes, Shweta.
Sir, don't we need to change the total for the fourth year as 2,300?
Fourth year, if it becomes 300, then we have to make it 2,400. But it remains at 200 only, then 2,300 only is the total.
Okay, sir. Okay, sir.
I made it 300 for the fifth year. And for
Yes,
the
sir.
fourth year also, yes. For the fourth year also, the total will be 2,300.
Okay, sir. Thank you, sir.
This I have calculated on the normal figures only. This purposely I am changing and showing to you. That if this happens, then what to do? For them, I have calculated, see over here. But the actual calculation is this. If these figures don't change, your actual calculations will remain like this only. And in exam, they will not change figures. They will give you for 5 years and you have to show the amortization for 5 years. That's it.
Okay, sir. Thank you, sir.
Right? Now, the next point that we need to understand is impairment. We have already learned impairment in our AS10, same logic. And we have one question based on impairment. It's a very good question. We will be doing it tomorrow, not today. Today we'll be doing the simpler questions now. Now, you know impairment. I've already taught you about impairment, but I'm just repeating the impairment point once again. If the book value is greater than fair value of the asset, the difference of book value minus fair value is impairment loss. It is charged to the profit and loss account and deducted from the book value of the asset to bring it to the fair value. And we have one question based on impairment in this question, where the cost of the asset is actually greater than the fair value of the asset. So technically, yeah, I was saying that in our topic, in our question bank, we have a question where the fair value of the asset is less and the book value of the asset is more. Book value means the cost incurred for the intangible asset is greater than the fair value of the intangible asset. So in that case, because of the impairment, we cannot record the intangible asset at its cost. We have to record at its fair value. And the difference of cost and fair value should be charged as amortization immediately. Amortization means it is as good as you are going to debit it in the P&L. So it is as good as what, as good as impairment only. So we'll be doing such one question tomorrow, not today. Right? Now, one more point before going to the questions, that is retirement and disposal. So this is the same point which you have also learned in AS10. An asset should be derecognized or eliminated from the balance sheet in two situations. First, when it is disposed. Disposed means sold off. And second situation, when no future economic benefit is expected from the use of that asset. In these two cases, eliminate the intangible asset from your balance sheet. And technically, when you eliminate it, there can either be a profit or loss on elimination, that is disposal. So that profit or loss will go directly to the P&L account as an income or an expense, as the case may be. It's that simple. No new thing. Only one point. This new one point. When the asset, intangible asset, is having no future economic benefit, means the intangible asset doesn't have the capacity to earn anything for you in the future now. The best example was last year from 31st March 2020, BS4 technology engines are not allowed anymore in the country. So if any company has a patent of developing a BS4 engine, that patent technically as on 31st March 2020 would have been completely eliminated from the balance sheet because the company knows it has no future economic benefit. Because you cannot manufacture BS4 engines now. And sir, across the globe, now only BS6 is allowed. BS4 is not allowed anywhere in the world now. It is all BS6 is also called as Euro 6. So technically Maruti, Hyundai, Tata, these all people had the patent of creating a BS4 engine, but all those patents were eliminated last year only because it had no future economic benefit. Because even if they manufacture a BS4 engine, to whom they will sell? It is not allowed only in the country now. Right? So here we will stop the topic now. Only disclosure part is pending. It's again big lengthy theory, so I'm stopping it now. We will go for some questions, some 2-3 questions we have to solve in the next 20-25 minutes. Right? So I would like to take first question number 1. Let's start with question number 1. Question number 1. A company had deferred research and development costs of 150 lakhs. Now, sir, here, deferred research and development cost. Deferred means they have already recognized this 150 lakhs in the balance sheet as an asset. So how can this be research and development both? Right? So my note will come in the answer stating that entire 150 lakh is development cost. Because research cost cannot be deferred. Correct? The sales expected in the subsequent years are as follows. So technically 4 years sales are given to you with the help of this intangible asset. These are the sales that you are going to develop in the next 4 years. So can I say pattern of economic benefit is available? Correct? What they are asking. You are asked to suggest how would the research and development costs be charged to the P&L account. Means how to do the amortization is what they are asking. Sir, since the pattern of economic benefit is available, I will amortize using the same benefits. Simply in the ratio of 4:3:2:1. Correct? And detailed formula you will write like this. 150 cost multiplied by 400 in first year divided by 1000. So you will get first year amortization figure. Then for second year it will be 150 multiplied by 300 upon 1000 and so on for the third and fourth year. So I think the answer comes as 60, 45, 30, 15. 60, 45, 30, 15 amortization figures for 4 years. This is the first part of the question. Second part is interesting. What is the second part? If at the end of year 3, it is felt that no further benefit will accrue in 4th year, how the unamortized expenditure would be dealt in the accounts of the company. So sir, at the end of 3rd year, we come across that in the 4th year, we will not have any economic benefits. So can I say that at the end of 3rd year, the intangible asset should be eliminated? Correct? So whatever is the unamortized value of the asset at the end of 3rd year, completely write it off. Means in simple terms, 150 is the cost of the asset minus in first year we have charged 60 rupees amortization and second year we have charged 45. So now only 45 rupees book value is left. So entire 45 will be written off at the end of third year. Don't wait for fourth year because you don't have any economic benefit available in the fourth year. So you have to eliminate the asset at the end of third year only by writing off the entire amount in the profit and loss account in the form of amortization. So entire 45 rupees book value that is left in the third year will be written off. Same journal entry, amortization account debit to asset. And amortization goes to P&L. Same like depre to asset and then P&L to depre. Same over here. Amortization of intangible asset account debit to intangible asset. And then P&L account debit to amortization. Same like depre. So let's check the solution. All the solutions are printed below the theory part. So you can check your material that I've already given to you. So based on the sales, R&D cost should be allocated as follows. So first year 400 upon 1000 into 150, 60 rupees. Second year 300 upon 1000 into 150, 45 rupees. Third year 200 upon 1000 into 150, 30 rupees, and so on for the fourth year also. So 60, 45, 30 and 15, these are the amortization figures for the first 4 years. And this is the first part of the solution. Correct? Second part. If at the end of year 3, the circumstances do not justify that further benefit will accrue in year 4, means you don't have any future economic benefit in year 4, then the company has to charge the unamortized amount that is remaining 45 lakhs. That is 150 lakhs minus 60 lakhs of amortization in the first year plus 45 in the second year. So total is 105. So 150 minus 105, 45 lakhs is remaining, and that should be charged immediately as an expenditure. So here my second part solution ends. And lastly, I have written that note. As per AS 26 on intangible asset, expenditure on research or on the research phase of an internal project should be recognized as an expense when it is incurred. It has been assumed in the above solution that entire cost of 150 lakhs is development cost. So that is the note we have written. Only till page 7, that is still disclosure. Okay, no problem. Question number 4. M Limited launched the project for producing product A in November 2008. The company incurred 30 lakh rupees towards research and development expenses up to 31st March 2008. So from last 1 or 2 years, they are continuously going on with the research and development, and total cost incurred on research and development both is 30 lakhs. Correct? Bifurcation is not given. Okay. Due to unfavorable market conditions, the management feels that it is not possible to manufacture and sell the product in the market for next so many years. The management wants to defer the expenditure. Defer means show it as an asset in the balance sheet and write it off in the future years. Advise the company as per the applicable standard. Can the company do this? No, sir. If you remember, I showed you some 6 points. The 6 points has to be demonstrated by a company so that the intangible asset with respect to development can be recorded. And in that 4th point was future economic benefit should be expected from the intangible asset. But here it is clearly written in the question that we are not expecting a market for our product in next so many years. So technically our product doesn't have a future economic benefit generating capacity. Hence it cannot be recorded as an intangible asset. It has to be written off immediately. So entire 30 lakhs should be written off immediately. Correct? So how will we present the answer? Sir, the first paragraph will be talking about the first paragraph will be talking about those conditions. We will not write all the conditions. We just have to write that the development expenses can be deferred or we can be recorded as an intangible asset if it can demonstrate all the conditions given in AS 26. Because if we write all those 6 conditions, it will become a too lengthy answer. So first starting with, as per AS 26, first we'll write about expenditure on research. So research expenditure should be expense immediately when it is incurred. So you should recognize it as an expense immediately whenever it is incurred. But an intangible asset arising from development should be recognized only if an enterprise can demonstrate all the conditions specified in para 44 of the standard. Now, para 44, if you remember, it's fine. If you don't remember, ignore. You can just write demonstrate all the conditions specified in the standard. That's it. An intangible asset should be derecognized when no future economic benefits are expected from its use according to the provisions of AS 26. Therefore, the management cannot defer the expenditure to write off to future years, and the company is required to expense the entire amount of 30 lakhs in the P&L account for the year ended 31st March 2010 immediately, because no future economic benefit is expected from the use of that asset, and hence it should be written off immediately in the profit and loss account. But if future economic benefit was expected, then yes, it should be referred to the future years. Yes, sir.
Sir, just a general question. Like in the question, it is mentioned that so many years. So is there any like limit on how the company?
No.
Because why I'm asking this is because for a company like Tesla, they want to go to, which is that other company? Elon Musk.
SpaceX.
SpaceX. For a company like SpaceX, they want to go to Mars. No, they don't know exactly, and they are spending so much on R&D, only R&D, sir. So they don't know when the future economic benefit will come. So for a company like that, they will have to expense the R&D every year.
Sir, what they'll do is research cost. If I'm following my AS 26, research cost technically goes to the P&L. Now, development cost is with respect to what? Developing a rocket which can take them to the Mars, and developing a software to run that rocket. 2 things are required: hardware and software. Yeah. Correct?
Okay.
So technically, the date when they are finally satisfied that yes, this hardware and this software can make us reach to the Mars, it can take 2 years, 3 years to develop that product. See, even after development, when you launch the rocket, there is no guarantee that it will reach. Yes or no?
Yes, sir.
So there is no guarantee that whether it will reach or not. So at one point of time, they are sure that yes, this rocket shall go. So development is completed. So they developed a technology. By using this technology, we can develop the rocket. So when the technology is finalized, all the calculations and all the algorithms are finalized, they can say that yes, with the help of this technology, I can develop a product. So it can take 2 years, 3 years, 4 years. So once that technology, the patent is developed, by the help of that patent, they will make the rocket. Because the rocket is a tangible asset for them. The rocket is a tangible asset for them, but the technology that they are developing by doing all the scientific calculations and algorithms, that is an intangible asset for them.
Yes, sir.
So all their calculations will be done first, and they will make patents of them. Whenever they develop something, immediately send it for patents, So many patents they develop. Samsung generally registers more than hundreds of patents every year.
Yes.
We don't even come to know about it. And Apple and Samsung always have a patent war. They always have it. So technically,
yes, sir, I'm aware.
The technologies that they are generating is the intangible asset. But when SpaceX will complete the technology, they will get it patented, so an intangible asset gets recorded, because now they feel that with the help of this patent, we can have a marketable product.
Yeah.
See, accounting is a beautiful art, and it is like a well. The deeper you go, it will go more deeper. It's not even well, I should say it is a sea, it's an ocean. And when you will start learning Ind AS at final, you will see there is no end to it. There is no end. Let us quickly go to the last question for the day. We have to
Thank you,
complete
sir.
this question. Yeah, welcome. You have to complete this question. In question 1, why it is not amortized at the end of 4th year? No economic benefit is there in the 4th year. So how can you use an asset when you don't have an economic benefit? That is why it gets written off in the 3rd year only. So when no future economic benefit is expected from an asset in the future years, it has to be immediately written off now. So at the end of 3rd year only, we have written it off completely. Let us read question number 6. Just a minute, I'll just connect the pencil. We have to complete question number 6 and then we'll wind up. Yeah. Question number 6. What it says? Base Limited is showing an intangible asset at 85 lakhs as on 1st April 2011 in its books. This asset was acquired for 112 lakhs on 1st April 2008. That is 3 years back. And the same was available for use from that same date. So since it was available to use from this same date, technically amortizations can also be charged from this date only. The company has been following the policy of amortization of the intangible asset over a period of 12 years on straight line basis. Sir, 12 years is not available now, sir. And I don't think so any justification is given. So technically, the company should not go for 12 years. They have to go for 10 years only. This is wrong that they have done. Right? Means I cannot say that it's an error. They have estimated the life to be 12 years, but they should have followed AS10 by AS26 by considering only 10 years. Comment on the accounting treatment of the above with reference to the relevant standard. Now, sir, please understand. A company is not allowed to charge amortization for a period greater than 10 years if it cannot justify. And in this question, I don't think so there is any justification given to us. Correct? So technically what the company has to do now, I know they have done this wrong. So what should be done? Sir, point number 1, now we have to give a retrospective effect. Now some people will say, sir, no problem. Now from this year only you change the life to 7 years because 3 years are over. So 85 lakh is your WDV left. So now divide it by 7 years and write off. No, sir. We are following straight line method. And as per straight line method, the depreciation for all the 10 years should be same. Right? And AS26 has clearly stated that, AS26 clearly states that if you have followed a higher period for amortization, then please make the retrospective changes to bring it back to the lower number of years, that is 10 years. So technically you have to give a retrospective, means you have to change the amount of amortization from 1st April 2008. So sir, shall we go back in those years and make the changes in P&L? No sir, that is not allowed. You have to do it from now. Means you have to adjust those amounts of amortizations in the current year because you cannot go there and change. So what is to be changed and how much is to be changed? Sir, for that please have a look at the question. How much is old amortization? 112 cost divided by 12 years life. So 9.33 per annum. 9.33 per annum. But sir, I think company has charged only 27 rupees as amortization. That is 112 minus 85 is the current book value. So I think they have not taken that 0.33. Because if you take this 0.33, then amortization amount should come 27.99. But they have taken 27. It seems that 0.33 will be adjusted at the end of the 10th or 12th year. So fine, sir, no problem. For us, 27 is amortization charged. But actually, it should have been charged as per 10 years. So this should have been the actual amortization. That is 112 divided by 10 years means it should have been 11.2 per annum. Right? So in 3 years, the company should have charged 33.6 as amortization. So now what company should do? Company should restate the opening WDV as if the amortization is charged as per 10 years. So this will give the retrospective effect. Means the actual opening WDV should be how much? Sir, it should be 112 minus 112 divided by 10 into 3. That is 3 years of amortization. That is nothing but 33.6 only. Means it should be 78.4. Correct? So if you show your intangible asset at 78.4, means technically the retrospective effect is given. Correct? But now what is your current WDV? Sir, current WDV is 85. So you have to bring this down to 78.4. Means you have to now charge further amortization that was not charged in the prior years. So therefore, further amortization to be charged as on 1st April 2011 in opening balance of PL account will be how much? Sir, it will be nothing but 85 minus 78.4, that is rupees 6.6. And there is one more way of showing 6.6 also. Sir, you should have charged 33.6, but you charged only 27. So technically 6.6 is further amortization that you have to charge to give the retrospective effect. And retrospective is compulsory only in this situation. Why? Because you are amortizing at a higher period of time as compared to the time period allowed by AS 26. Lower period is fine, but you have taken higher period. That is why we have to give a retrospective effect. Yes. Yes, Anjana.
Sir, basically retrospective effect means doesn't mean that we're going to change anything in the previous year's statement, but we're just changing the opening balance in current year's statement.
Correct.
Okay, sir.
So when you change the opening balance, automatically it gives a retrospective effect.
Okay, sir. So, but in this question, how can they charge for 12 years, sir? It isn't
They have
allowed.
done wrong. I think they did not read AS 26 properly. Their accountant is not aware.
Okay,
That is only
sir,
I
but
can say.
is it really possible?
In real life, no. But
Okay,
this
sir.
generally happened when transition took place. Means AS 26, I think, came from 1st April 2006. So before 1st April 2006, people were doing 12 years, 15 years accordingly. But when they transited to AS 26, so during the transition period, the AS 26 people told that you have to give a retrospective effect now and you can maximum amortize over a period of 10 years only. So these questions are basically of that era.
Okay, sir.
But now it is not possible because now AS 26 has come into existence from last 16 years. 15 to 16 years it has happened. So now everybody knows that the life is only 10 years. So nobody goes beyond 10 unless they have a justification.
Yeah, okay, sir. Thank you, sir.
Now, we'll just have a look at the solution. Yes, Ritika.
So in this question, can we give a note that if the company has provided a justification, then they're doing the right thing?
No, don't do like that. No, strictly avoid it. Don't do that.
Okay,
You
thank
will
you,
lose
sir.
marks. Don't do that. Right? Now, first we will write the provision paragraph, which is nothing but the definition of amortization, followed by maximum life is 10 years, and you will start amortizing when the asset is available for use. So these 3 points have to be noted. So we'll start. As per AS 26, the depreciable amount of an intangible asset should be allocated on a systematic basis over the best estimate of its useful life. So this is nothing but definition of amortization. There is an rebuttable presumption that the useful life of an intangible asset will not exceed 10 years from the date when the asset is available for use. We are talking about the time period. And amortization should commence when the asset is available for use. So these 3 points are written in the provision. First, definition of amortization, maximum amortization period 10 years, and amortization should commence when the asset is available for use. And now the given case. BS Limited has been following the policy of amortization of the intangible asset over a period of 12 years on straight line basis. The period of 12 years is more than the maximum period of 10 years specified by AS 26. Accordingly, BS Limited would be required to restate the carrying amount of the intangible asset as on 1st April 2011. That is nothing but opening balance has to be restated at 112 lakhs less 33.6, because 33.6 should be the actual amortization. And I've shown in the bracket 112 divided by 10, you get 11.2 per annum into 3 years. So technically the asset should be shown in the opening balance as 78.4 lakhs, right? And the difference of 6.6 lakh, that is currently you are showing at 85, but you want it to show at 78.4. So you have to reduce the value by 6.6 lakh, which will be amortization that will be charged. So 6.6 lakh will be adjusted against the opening balance of revenue reserves. You will not show it in the current year's profit and loss. You will adjust it directly in the opening reserves only, because these are due to the retrospective effects. So with respect to the retrospective ones, you have to adjust in the opening balance. Don't adjust in the current year's profit. The carrying amount of 78.4 lakh, that is the revised book value, would be amortized in the remaining life of 7 years. That is at 11.2 lakh per annum. And if anybody wants the journal entry for this on 1st April 2011, the journal entry will be PL account debit 6.6 to intangible asset account 6.6, and this PNL will be adjusted against opening balance. Means, say in your balance sheet you have PL at 100. Now this is balance sheet as on 1st April 2011, opening balance sheet. So in this 100, you will subtract amortization 6.6. So it becomes 93.4. So don't show this in the current P&L. Show it in the opening balance of P&L, because this is a retrospective change. I hope you understand the point. Correct? I want you people to please try question number 2 at home. You please try question number 2 at home. This is the working. You can take a note of this. You can try question number 2 at home. It is a same question as question number 1, where you have to show the amortization calculation. I think some 10 years data is given, but first year, second year, third year, for these 3 years only, the amount of inflows are different. And from 4th year to 10th year, the inflows remain constant. So you can show the calculation as first year's amortization, second year, third year, and directly 4th to 10th year together, so that you can save time in exam. You just have to calculate the amortization. And see over here, they have given the production also, and they have given the operating cash flows also. So always remember, amortization is never done on the production basis. It is done on the basis of cash flows, that is future economic benefits. And future economic benefits, you can see it is given. First year 900, second year 1800, third year 2300, and 4th year to 10th year it is 3200 only. So what you can do is, first year calculate separately, second year separately, third year separately. and 4 to 10 years together. That is like this, 4-10 per annum. So the amount will be 3,000. The cost of the asset is 200 lakhs. So it is 200 multiplied by 3,200 divided by the total of this. So what is the total of this? 3,200 into 7 plus 2,300 plus 1,800 plus 900. Total is 27,400. So divide by 27,400. And for first year it will be 900 divided by 27,400 into 200. For second year it will be 1,800 divided by 27,400 into 200. And for third year it will be 2,300 divided by 27,400 into 200. And this will be for the fourth year onwards. Solution is already printed, but please solve it once again in your book. Question number 2. So balance questions we will solve tomorrow, and we will also start with AS29 tomorrow. Correct? So we'll wind up the session now. Yes, Niyati.
So just one clarification, when intangible asset has active market, so in that area, in purchase consideration, it is assumed that fair value of that intangible asset is already included, right? In purchase consideration.
No, what examples we saw in the purchase considerations, the fair values of the intangible assets are not shown. Because if they are already shown in purchase consideration, then there is no point of discussing all these things.
No, sir, because the fair value actually we are adding up to the net assets taken over, and the similar effect is being shown in the capital reserve or goodwill, whatever may be the situation. But sir, we are not doing any adjustment of asset fair value in this purchase consideration.
Nothing will be done because that company has got nothing to do. Company has told that take these are all my assets. And in that and for all these assets you give me 50 rupees. Now in that, if any intangible asset arises, which is of your benefit, then you can record. Say you got a huge customer data. That is an intangible asset and it is beneficial for you. And sir, for that data, there is a market value. I don't know whether you're aware or not. Students' data is available in the market at 2 rupees per student data. Which is you can get the data of any student from the market. If you want data of a particular college, there are agents who provide this data. They take 2 rupees or 1 rupee 50 paisa or 3 rupees per data depending upon the party and quantity of data.
Okay.
It's a common practice in Mumbai. Many people take the data. You will not even, you are not wondering your mobile number is a data. Are you aware? If you enter your mobile number at one place, it gets circulated to 50 people. And sir, data is the biggest business now worldwide.
Correct. Yes, sir.
So you can get it.
So basically,
can be available.
So basically, the purchase consideration is something which we are paying in a lump sum amount, and this payment includes both tangible as well as intangible assets amount.
Correct.
Okay.
And if there are already recognized there are some recognized intangible assets, so they will charge for them in the purchase consideration. So you have already paid for it. So in that case, no need to work out the fair values or anything as such. You can directly show it.
Yes, sir. Got it, sir.
Right?
Yes, sir. Thank you, sir.
Yeah. Nikita.
Yes, sir. Now, as the portions is getting over now, sir, can you tell which accounting standard is more important, like comparatively, how much time should I give for the important ones?
Madam, actually, you're not audible clearly. There is a lot of echo around. I think you're sitting in a very closed room or something like that. I'm not able to hear you properly. Can you please speak a bit loudly?
Yes, sir. Sir, as the portions is getting over, sir, can you tell which accounting standard should I spend more time comparatively?
We'll tell everything about this in the last session. Don't worry.
And sir, the order in which I should read the accounting standards.
Everything I'll tell you. From A to Z. How to study, what not to study. Still 2 AS are pending. Let me complete that. After that, I'll tell you everything. Which AS to focus more, from where questions come, what type of question come. Everything I'll focus. On the last day, even after the end of session, I can wait for 15, 20, half an hour extra and tell you all these points and then I'll end the session. Don't worry. That is my word.
Thank you, sir.
Yes. Yes, Adarsh. Aditya, sorry.
Sir, am I audible, sir?
Yes, yes.
Sir, can you please open amortization in nature of purchase?
Amalgamation.
Amalgamation.
Yes. Yes, opened.
Sir, in that third line, there is recognition criteria that meets recognition criteria. What does that mean, sir?
Point number A you are talking about?
Yes, sir.
What it says, a transferee is nothing but the buying company. The buying company can recognize an intangible asset that meets recognition criteria. So if for you are the buying company and for you the intangible asset meets the recognition criteria, then you will show it in your balance sheet even if the selling company did not meet the recognition criteria.
Sir,
So
what
even I
is the
told
recognition
this point.
criteria, sir?
So recognition criteria are those 2 points. Cost can be measured reliably and you have a future economic benefit associated with it.
Yeah, okay, sir.
That is the recognition criteria.
Yes, sir. That's what my doubt was, sir. Thank you.
Oh, yeah, very good. Right. So I think no further raise hands. Sir, I made a Telegram group. Please send to everyone. Sir, you please look out after those